So just a general description of a market. So what is a market? Basically an interaction between just buyers and sellers who will determine a market price. So think of it like you're going to the palengke and you're going to your suke, you want to buy vegetables or meat. When you arrive at your suki stall, it's full of customers wanting to buy everything he's trying to sell. What do you think will happen? Generally, the prices, because the demand is high, the prices will tend to be, or he'll try to push his prices up. On the contrary, if you go and the stall is empty and he's doing nothing except, surfing on his phone, chances are you can make tawad and you can bring the prices down. So prices are always driven by demand and supply, and it's the same in the stock market. So general market's function is to find the equilibrium, the price where buyers and sellers will meet and agree and make an exchange. Okay, so what is the stock market? Again, it's a marketplace, but this time for investors to buy and sell shares of companies. So shares, also called stocks, equities, go by many different names, but those are usually the three that we'll go and use throughout this discussion: stocks, equities, and shares. The PSE, or the Philippine Stock Exchange, is where all trading happens in the Philippines, right? Okay, I was going to say you can't trade unless you trade through the PSE, but actually you can. That's an over-the-counter market, but it's completely different rules, so we're not even going to get into that today. And shares are bought and sold through trading participants. So basically, a trading participant is just a fancy name for a stockbroker. So RCBC Securities is one of the trading participants among, I think there's 150 now that are active roughly in the PSE. So anyone who wants to buy and sell shares or stocks of listed companies must go through a stockbroker or trading participant. Okay, so what are stocks? Generally, stocks are just units of partial ownership in a company. For this purpose, we're talking about listed companies, so companies that are listed on the PSE. There are two types, basically, common stocks and preferred stocks. In a minute, I'll show you the differences. And stocks always have associated values with them, whether it be the stock price or dividends that are paid out, which I will also explain in a bit. Okay, so here's the primary difference between preferred stocks and common stocks. When I was younger, preferreds were not really something that was traded. Unlike today, there's a wealth of preferred stocks that are listed in the market. Before, it was all just common stocks, no? So the basic difference are ownership in the company, both preferred and common stock. Yes, you are a partial owner once you buy shares in that company. Upside and growth potential. Okay, with preferred stocks, they are limited. And they're limited because preferreds normally are bought because of the dividends that are paid out. They pay a fixed dividend. So when you invest in it, you know what you're going to be receiving every quarter, every month, every quarter, every half year, or annually. Depends on how they pay dividends. Growth potential, if they are convertible, meaning at a later point in time, the shares can be converted to common shares, there's potential for higher growth and upside. With common stocks, growth and upside is unlimited. But I also have to point out that there's an upside, there's always a downside. So downside could also be unlimited. So it's something to bear in mind when you're making your investment decisions. In terms of dividends, again, I mentioned earlier, preferred stocks pay a fixed dividend, a fixed rate, so you know exactly what you're getting every time. With common stock, the board dictates what the dividend payout will be, and that generally varies from year to year. It could be higher or lower depending on how much the company makes, in the previous year. So common stock dividends are not, you can't count on a fixed rate year in and year out, unlike preferred stocks. So again, I just mentioned about the payout. So fixed dividends with higher yields. Again, preferred stocks tend to pay much higher yields on a regular basis, whereas common stock, again, varies and the dividends are not guaranteed. Again, it depends on whether the company makes money or not and decides to declare a dividend or not. In terms of risk, preferreds are medium risk and medium in terms of price volatility, bonds being the lowest risk. But we're not talking about bonds today. Common stock has the highest risk and again, the highest price volatility. Voting rights, if that's something that interests you, you want to go to the annual meetings or participate in certain decisions that the company has to make and has to ask the shareholders to vote on. If you're holding preferred stock, you don't get any voting rights. If you own common, then you can participate in the voting. And in the worst case scenario, in case a company goes bankrupt, distribution of assets, again, bonds are first, preferreds come second, and common stock is always last in the line. Okay, so let's look at a few reasons why a company would want to sell their shares, right? So one is to raise working capital. So they can't raise it internally or financially they're having difficulties, so they might go to the markets to raise working capital for acquisitions, for expansions, for debt reduction, and several other reasons. I also just want to point out here, when a company does an IPO and the primary reason for doing the IPO is debt reduction, that tends to be a red flag, at least for me. I'd like to see my invested funds going into, acquisition, expansion, R&D, and things like that, rather than just paring down debt. So when you're going to participate in an IPO, and I don't have it in this slide, it's very important to read the prospectus. The prospectus is like a thick document that explains everything about the company in relation to the IPO, the initial public offering. So it's very important to see the section for the sources and uses of funds, because that's where they clearly explain what the funds will be used for. So something to look out for when you're looking at to invest in an IPO. Kind of jumped ahead there. So yeah, companies will sell shares to the public through an IPO or a FOO, follow-on offering. So an IPO is initial public offering. Once that's done, the shares are trading over a period of time, they may want to raise money again. If they do that, one option is what's called a follow-on offering. So they will have a new offering and issue new shares to the public. And this is basically how it works. Now, the primary market is where shares for the IPO are created, right? They will either generate new shares from unissued and authorized capital, or they will issue them from authorized shares. The companies will go through brokers like us to solicit clients to invest in the IPO. At a certain point, the IPO will close. The investor will have to make his payment for the shares that they've reserved and have been allocated. Sorry, one sec. Once the IPO is listed, that's now in the secondary market. So the secondary market, unlike the primary market, are where shares are traded. So you can now buy and sell shares in the secondary market after the IPO. And again, everything goes through stockbrokers. So you can only buy and sell through the stockbrokers. Even if you have an online account, which we'll talk about later, it's still an online account of a specific broker. So even if you are personally executing your trades, it's still going through the brokerage house. Okay, so some investment considerations. We talked about ownership very quickly. So again, one of the considerations is you're a part owner in a company. And I always like to think like an owner. It tends to make me make rash decisions and hold for a longer period of time, as opposed to just being a trader and going in and out. Liquidity, very important. Two aspects of liquidity here. One, it's a very liquid asset to buy and sell. So anytime you want to buy or sell, there's always an available quote on the market for the price for the stock that you're looking to buy. And settlement is 3 days. So if you sell and you need cash, within 3 days, you're paid. And it's a quick process. There's no paperwork or anything like that, no contracts or anything. So it's very liquid. And also liquid, I mentioned that on any given day, any company, any listed company will usually have a quotation on the buying and selling side. So if you want to get in and out of any company on any given day, generally you'll be able to do it at the prices that are posted. Income generation, of course, as we mentioned earlier, one of our primary reasons is to grow our money, to generate income out of it. There are two ways to do it when you invest in stocks. One is through price appreciation. Simply stated, buying at a lower price, selling at a higher price, right? So if you buy at 10 pesos and you sell at 12 pesos, you've made 20%, and that's your gain. The other way is through dividends. And these are distribution of corporate profits to eligible shareholders. There are two types of dividends. One is a cash dividend, where they pay you in cash. They will announce when the dividends are payable, and once that date comes, you will receive a check or you will receive a direct deposit in your bank account, depending on how you structure it with your broker. Same as stock dividends. These are paid in stock. So let's say you have 1,000 shares and they declare a 10% stock dividend. On payment date, you will receive 100 shares into your account, and you will then have 1,100 shares after the dividend is paid out. So cash and stock dividends are the two ways to generate income from the market. And then the last one is it's an inflation beating asset. This chart here, I always like to show, because when I started in the market in 1986, and that will date me clearly now, the index at the end of 1986 was 129 points. Okay, so 129. Today, the index is at about 6,600. So if you just go from the bottom of that chart to the peak, at the top there, which must have been about 2018 when the market touched 9,000. That's 32 years. Over that time, the market has grown 7,000%. So what does that mean in plain English? 70 times your money. If you were lucky enough to invest 1 million pesos back then and you held it all the way till 2018 at the peak, your holdings would have been worth 70 million at that point in time. But just to give you an idea, over the last 10 years, the average annual return of the market has been 6%, mainly dragged down because of the last 2.5 years of the pandemic, but still 6% over 10 years, right? The last 15 years, 7.7, and over the last 20 years, 12.5% return. So on an average, the market is continually growing. On an annual basis, there may be years that it's up, there may be years that it's down. But again, on average, it's growing, as I mentioned, 6, 7.7, 12.5%. Inflation today is what? Call it 5%, 4.7, right? So it is definitely over the long term an inflation beating asset, and actually one of the best asset classes in terms of inflation beating.